Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by Cal State Bakersfield Small Business Development Center. Good afternoon, I'm Kelly Bearden. I'm your host today, and we are here for webinar number 293. It's October 4th, 2023. Got a great HR topic today, a lot of things going on in this particular area that we need to talk about. So here we are. Let's get going. So what's up today? October 4th, 2023. Well, first of all, gotta wish a very happy birthday to one Magnus I. Bearden. Yes, the one I call Mags is 3 years old. So happy birthday, Magnus. And also, who would be remiss if we didn't wish your Uncle Hank a happy birthday today too. So October 4th is back to birthday wishes here on Webinar Wednesday. Hope both of you have a great and exciting birthday today. And we're going to be talking about exciting things here today. We're going to be talking about wage theft. Now, a wedge theft, that would be interesting, but wage theft and also other HR law traps that you can get your business into, oftentimes without even knowing. So we have our HR specialist, our restaurant guru, Celeste Young-Ramos will be joining us later, and to talk about a lot of these particular issues. And we'll even drag into some of the other local things that we find. And one of those local to Webinar Wednesday is always the Capital Quarter. And so in addition to our other feature, the Economic Corner, our Capital Corner, we'll talk about, of all things, the economy. Our Economic Corner will be weaving in with our special guest today on the coming up food increased wages to the minimum wage in the state of California. We'll throw out a few strategies and maybe for struggling food businesses as we see some alarming statistics on business failures and other things coming around along the bend. We'll be analyzing a really kind of got us going on this topic again was, kind of a disturbing article last week in our local newspaper, The Californian, on a local business, a local franchise, and his $3.1 million bill from the Labor Commissioner. And we're going to look into what that constitutes and a little bit of the details of what is involved in all of that. We cannot be, moving forward without our community calendar and the events that are coming on. A last mention of the IRS and their pausing in funding for the ERC, the Employment Retention Credit, the applications that are out there, a lot of the things going on in that particular space. We'll answer your questions today. So if you have a question for Celeste, please go to the Q&A box, or for yours truly. We will be looking at the Q&A box. We have our webinar producer, Maureen Busher-Dang, working in the chat box with resources for you today. And no poll today. Too much going on. No poll today. So really kind of where we came up with this week's topic is this article that was in the paper last week. And what it is it's basically a little bit of a $3 million order to pay for alleged wage theft. And I do look at that title, that headline title, that local franchisee ordered to pay more than $3 million for alleged wage theft. And so the wage theft we'll talk about, and we'll kind of look at the different parameters of that. And if you skip to the second to the last paragraph, maybe I could highlight it for you, maybe not. We'll look at some of the things, the factors that go into that 3.1 million, and we'll come back to this. The big thing that I see on there is $1.197 million in civil penalties payable to the state of California. Okay, now just a little heads up on this. The individual who has been alleged to create this wage theft is not a client of the SBDC. Maybe that's a good reason to be an SBDC client, because it's confidential. I couldn't talk about it then. But it's not an SBDC client. I do not know the individual other than the fact that as an advocate for small business, I see some particular issues of what's going on here, and I will gladly tell you about those as we move on. So that's kind of our discussion point today. And since even though we do talk about and have so far this year on Webinar Wednesday, had Celeste on to talk about the HR requirements, they are very difficult, and they are very difficult for small businesses that have so many other things going on to recognize and to basically fulfill all of those. So we will talk a little bit about those today. In sticking with our food service format, many of you know that we have been promoting the Bakersfield Food Service Management Program that is expertly taught by Celeste, and it's through not only the SBDC, but our partners at Cal State Bakersfield through the Extended Education, also known as Extended Education Global Office. And so a little bit about this program and where it came from was it was basically kind of devised through some discussions with the head of EGO, Extended Education Global Office, Dr. Mark Novak, and myself and his team last year when we started talking about some gaps that were out there as far as food service businesses. And we talked about a lot of the issues and a lot of the trials and tribulations that food service businesses coming out of the pandemic faced. And a lot of these were mom and pop businesses, smaller independent businesses, maybe some small franchises as well. But really a lot of issues coming out of COVID. Not only the smaller ones seem to have less access to a lot of the resources from COVID, labor supply, inflation, we could go through all these again and again. So just as kind of a benchmark, this program is still open, and we're still using it for individuals who want to apply to the grant funds available from the city of Bakersfield. So those programs are still going and still available. Here we are with our weekly feature, Capital Quarter, where we look at the debt ceiling for small business. Yeah, you know, we almost shut down the government last week. And then, you know, a few months ago, it was the debt ceiling, increasing the debt ceiling so the government can continue to operate. Well, we came up with a debt ceiling for small businesses. What are those factors that can limit your ability to raise capital? And we've gone through these 7 of them. I won't labor the point on these important factors that you need to know in order to continue to get access to capital for your business. And Celeste jumped right in the middle of this one, which is our latest one. And our latest one is going to be it's the economy stupid. Yes, that famous quote by then President Bill Clinton in between his first and second term, when he came to the realization that maybe his biggest problem was the economy. And so his forever popular, "It's the economy, stupid. It's the economy, stupid." Got to work on that. So it happens when you've been out of office for so long. So oftentimes what it could mean in this particular case, it can be a factor to raise your ability to raise capital for a small business. It can be the economy. It could be high interest rates that are now for a lot of SBA loans hovering, you know, in the 12% range, maybe sometimes higher. If you go to any of the other particular predator type businesses, you could even get up, as we've talked about earlier, in the 20s, 30s, and 40%. So being the economy and being some of the issues are not only higher interest rates, but with higher interest rates comes the threat of recession that we've had. And we can have not only less cash flow from a higher interest payment or a higher business payment, but also expected less earnings that can come for our business and less revenues because of some of the factors that are going on in our economy. So really, of the 10 that we've identified, this is the one that is most out of control for you as you go forward. But the simple thing is that the economy can prevent you. Banks tighten during an economic slowdown. A lot of factors can happen, but they do rebound. And maybe now isn't the right time for you to get capital to grow your particular business, for example. So again, a simple fact, it can be the economy that can be one of your factors for limiting small business. So now we will go to our special guest today. Our special guest speaker today is Celeste Young-Ramos, and she's the founder of the Restaurant Success Center and works a lot with restaurants and human resources. as a human resource and restaurant consulting firm. She's worked with the CSU Bakersfield, I believe now about 3 years, and has included, her past history includes 20 years experience as a human resource manager and franchise directors for a larger franchisee in Southern California, and over 3 decades in the food service industry. So Celeste, welcome back. It's great to talk to you today.
All
Let's
right.
talk about this topic.
Well, Kelly, definitely. You started it off good today with some of our discussion about wage theft. And so that's where I'm going to share some of that because there's been a lot of newer legislation over the last few years regarding wage theft that we are starting to see. Whoops, sorry here. Starting to see come out in the industry. So I'm also going to share with you some of the mid-year human resources updates that legislation that's passed throughout this year and a couple that are pending. So we'll go through the new fast food minimum wage that'll be coming up in April. We'll talk about wage theft, changes to the California Family Rights Act, and also the Paid Sick Leave Act. And then we'll talk about some other new laws and follow-ups. Particularly, we have a new I-9 form out there that people need to start using at long last. So let's start off with our fast food wages. So as you know, last year they were trying to pass the FAST Act that was going to impact the restaurant industry for fast food chains across the country. If they were a chain from across the country, it would affect them here. And they were trying to raise the minimum wage to $22 an hour. They were also trying to have a council that would pretty much take over the legislation of the fast food industry. And this was being pushed by a lot of organized labor. And they were actually going to put it as a referendum on the next voting cycle to see if this would pass. One other fear was that they were trying to also cause it that franchisees would become a joint employer. The franchisor would become a joint employer with the franchisees, which would pretty much eliminate the franchise model here in California. And so just recently, Governor Newsom signed what they call the fast food wage bill. It's Assembly Bill 1228. And with this, as of April 1st, 2024, if there's a fast food restaurant that's a national chain that has 60 or more units nationally, they're going to have to move the minimum wage up to $20 an hour. They'll also appoint this council that will help to look over and make recommendations to the state legislature about other changes in the industry, but they're not going to have as much power. And so this is going to be a big hit for our industry. Pretty much any fast food restaurant that's out there, that's pretty much out here, that's not a regional chain, will end up having to move the wage up to $20 an hour. And of course, as we see compression there, we're going to see that also translate out into other restaurants as well. So that's kind of the big news. We'll see how that pans out here in the future. Also, we've had a couple articles in the news about wage theft, and as Kelly mentioned, there's one here in Bakersfield for Wingstop, where they allege that 551 employees at these 5 locations. So as you can see, 551 employees. This is over a period of at least 3 years, because in these types of lawsuits are called PAGA lawsuits, Private Attorney General Act. If they have a labor issue at one location, that kind of almost creates a class action suit in the business. So they can then sue and look at everything, all the labor practices for the last 3 years for current, past employees. So that's how we're coming up with 551 employees, because I doubt there's, there's not 100 employees working at each one of these restaurants right now, but they're looking at the records going backwards. So what in this case, what it's looking like from the articles that I'm reading is that all of the restaurants were operating as single individual entities, so they were different companies in themselves. But what they were doing was they were sharing all the employees from one location to another, and they were managing all the locations as one central unit. So we always say, if you're going to open up multiple restaurants, it's always good to have a different entity so that you can keep the sins of one restaurant to that location and not taint the other locations. But unfortunately, if you're using a centralized form of management, it blends everything together, much like with the Obamacare. There you have to have 50 employees in a location, but if you have other locations and they're within 75 miles, you then might hit that 50 count and have to do healthcare. So in this instance, what it looks like what was happening was maybe one restaurant at the time only had 20 employees. And so they were taking the wage at a lower minimum wage, which at the time was like, I think $14.25 for this state. Maybe it was even 13 at that point. But they were using those employees at both restaurants. So they would work at one and then they would go to another one. And the state is saying that, because they had all of these and they were managing this one single business, they were well over the 25 employees for that lower minimum wage. So they should have been paying the higher minimum wage. Also with this is the overtime. And I worked at a franchise where they did the same thing. And at the time I was like, well, I don't think we can do that. It's like they'd work their day shift and then they go work a night shift over at another location. And so they wouldn't pay overtime at the second location, but that's improper. And also because of the length of time they were working between the two stores, they should have gotten their breaks. And also it said that they weren't paying them for the transportation time going from one location to the next. So this was a very interesting case, and it definitely racked up a lot of fines here. And so it's always really important when you set up your business structure that you always talk with a labor law attorney and tell them all the things that you plan to do and not make assumptions of what's okay and what's not okay. You really need to run that through. So that was quite a bit of fines, and a good portion of this was in penalties to the state. So, even when you have a non-break, for instance, the penalty, if you have someone that doesn't get their break and have their break started by 5 hours into their shift, it has to start before the beginning of the 5th hour. You have to pay them a premium wage. So that means you pay them for the full hour. You have to pay them an hour's wage. So sometimes, like if we're missing break, you have to take action, because that one break, you're trying to avoid maybe paying them $17 or an hour, but you're going to get $100 fine for not missing the break. You're going to get $100 fine for not having it recorded correctly on their paycheck that week. And you're going to get a $100 fine for paying them late because now you owe it to them. So where we're trying to save maybe, $17 up to $20 of wage, we could get a $300 penalty and be charged that for every single week that it's incorrect. So that's quite a bit. Now, there was also another case recently here in California where 14 subways were charged nearly $1 million in wages and damages. And these folks were actually told by the court that they had to sell or close their businesses by November 23rd of this year. So I haven't heard that before, where they've actually told restaurants that they have to close. This was a new one for me. But what they were doing there at these subways, they were working with a lot of minors and having them work on equipment that they're not allowed to work on. So for instance, slicers and those types of equipment, they need to be over 16 years old to operate those pieces of equipment. They also weren't following work hour rules. So they were having minors work past the time that they're able to work each day. They were also delaying in pay with hundreds of bad checks. And so what brought this about is an employee complained about not getting paid, and they got paid with the bounce check. And that brought up one restaurant being looked at, but how they were managing these all as a group once again, it then kind of shifted over where they were sharing employees from so many locations that it opened up this investigation into the other 14 restaurants. Also, the owners were keeping tips. Owners are not allowed to keep tips or to keep portions of the credit card processing as well. You can't reduce that and keep that for yourselves. So that, along with other things such as like not paying people bonuses they earned or commissions they earned, not distributing the tips correctly. They even, from some lawyer resources I've looked at, they're even saying that if you don't pay people on time, that could be it as well. So a lot of opportunity there, and we need to be very careful because it can be very costly to your business. The average PAGA lawsuit in California is $1 million. And majority of that is going to attorneys and the state, and only 25% of any of that goes to the employees. Now, another thing that came across in 2021, while we're all in COVID, we're not really paying attention, is they passed legislation called the Wage Theft Act of 2021. So now, if you take intentional theft of wages from employees in amount of greater than $950 for one employee, or you have $2,350 of an aggregate of 2 or more employees in a 12-month period, is now punishable by grand theft. So that can be definitely, that's a criminal violation. So I think it's really important that you look at the practices that you're following in your restaurant to make sure that people are properly compensated. Like refusing to give people sick leave might also fall for this. Not doing gratuities or not giving them a benefit that they should be getting. So like charging people for breakage or things like that. So you have to be very, very careful. The key thing here is it intentional? So if you definitely know that it's against the law, you know, then you're going to be more apt to fall into this category. These 2 other cases that happened here, we'll see how that handled. They were what we've seen so far is through the labor department, but doesn't mean that an employee can't go and file an intentional theft issue for a criminal issue. Now, one thing that I see a lot when I go out and do audits of different businesses to see how they are with all their HR policies, and that's really something that I would encourage you to do, particularly if you're kind of a mom and pop kind of place. I do a lot of that for like legacy type restaurants where they've been doing something one way for so many decades and they don't keep up with the new California labor laws. And that's why I got certified when I was a restaurant operator in California labor laws, because that's where I was seeing we had the potential of getting attacked with large sums of money. So when I do an audit, one thing I always look for is, are they passing out the notice to employee? This is a required form that you're supposed to give to every employee that gives them all the information about their employer, their workers' comp, carrier, and also the sick leave policy, because those are the main ways that wages can be stolen from the employees. And so when I talk to a place and I'm asking them about sick leave and the employees give me the blank stare in the eye about what in the heck is sick leave, then I know they've never received this form before. And this is just a cutoff part of it, just to kind of show you what it looks like in case you didn't know it by name. It's actually an 8.5 by 11 form where you'll fill in the information, the employee's wage, what they'll get paid overtime, when payday is. And if you make any changes to their wage or the workers' comp carriers or anything, you have to send them another copy of this within 7 days. So I highly encourage you, if this is the first time you've seen this form, you need to get it to your employees. Okay, now let's go to the next one. Now, also with the minimum wage going up here in California, sometimes when I talk to different businesses and they tell me they have salaried employees, I start asking questions. Because if you're going to have a salaried manager, there's a few rules that have to be followed. But one of the big ones is that you have to pay them enough. So if you're not paying your salaried manager at least $64,480, you're in violation of the California labor law. And you could get a penalty for every week that you've underpaid them. So right now they should be getting about $1,293.26 a week in pay. And they calculate that by 2 times the state minimum wage times 40 hours. And that's how you'll come up with that number. They also have to be supervising employees, and they also have to be involved in the hiring and firing process. So it's not like you can have like your main cook, you know, at your restaurant, for instance, and all they're doing is cooking and kind of watching things. If they're having to do more than 51% of their time in actual working as an employee, then they're not going to meet one of the criteria for them to be a salaried manager. So in our industry, we've seen a lot of salaried managers be moved to hourly because they're not meeting those 3 areas. Okay. Also with pay scale disclosures, if you have over 15 employees, you're now supposed to post that on every job posting, whether it's in your restaurant or your business. And you'll hear me say restaurant 50 times because that's who I work predominantly with. But if you also post jobs on, you know, Indeed or any other place, you now have to put a range. Now, if you only pay servers minimum wage, then you can have one set salary and that could be the range. But generally, otherwise, you'll need to have the range. And if employees or applicants ask what the range is, you're supposed to ask them. You're supposed to tell them to them. Non-compliance of posting these job ranges is a $10,000 fine. They also are requiring you to keep records of all the job titles and wages that each employee has had, plus during their employment, plus 3 years after their employment ends. So I guess they can come back and audit later. So a lot of follow-up there. And if you have over 100 employees, you do then also have to report it on a government website. But I didn't include that because most of you are small business owners. Okay. Also, there's a new I-9 out there. So we've been waiting. They expired in October, like a year and a half ago. And they just recently came out with a new one. The new date, which you'll see up in the right-hand corner, is July 31st, 2026. So you'll want to start using this form for all your new hires. Before, there was a 3-page document. It had 1 page that the employee filled out within 1 day of hire. Then it had a page that the management filled out to check the ID. And then it had a page that gave you all the acceptable types of ID that you could have. And now they've added a 4th page where they actually have a spot for like re-verifications. So there's 3 spots for if you rehired someone, maybe they had a name change or you had to update someone's authorization. Now that's available. So you'll want to get these printed out, make sure that you go through it thoroughly so that you're up to date. Also on the California Family Rights Act and also the California Paid Sick Leave, there were some changes in January. So the California Family Leave Act really applies to businesses that have 5 or more now. And so with this, they've added a designation for what they call the designated person. So before, for either one of these leaves, the family rights leave or the paid sick leave, they could have time off to take care of their own health needs, or a direct line descendant, parent, grandparents, siblings, kids. But they couldn't do aunts and uncles and kind of those other more extended family members. Now they're putting on also a designated person. So an employee can be out to help a designated person. So one thing I would recommend in your policy that you update it to say that they can designate only one person per year. So that way they can't just be taking it off for like 13 different people. So that is where you're going to give them protected leave, that they can be out without pay. They can then go apply for paid leave through EDD. But this also, this designation also applies now to the paid sick leave. So before, designated people weren't involved in the California paid sick leave 3 days or 24 hours. So that's a new change there. And right now there's legislation waiting for Newsom to sign. It's already passed the rest of the legislature, expanding sick leave from 3 days or 24 hours to 5 days or 40 hours per year. It'll still accrue the same way as before. If you do the accrual method, 1 hour for every 30 hours. If you're using a bucket method and this does pass, you'll have to do 40 hours filling the bucket. They can roll over up to 80 hours. So that's 2 years, double what it currently is. However, you can put a rule in your corporate policy that you won't pay out more than 40 hours or 1 year's worth each year. So, so that you won't be getting someone taking all 80 hours at one time. So that we're pending. They're expecting it might pass in a couple more, that he might sign that in a short time. So just something that's on the horizon. Also this year, they passed bereavement leave. So if you're an employer, 5 or more, you have to allow up to 5 days for employees who have a qualifying family member that passes away. So this is a spouse, a child, a parent, a sibling, a grandparent, a grandchild, a domestic partner, or a parent-in-law. And the employee has to have been employed with you at least 30 days. And they can use it within 90 days of the death. There is no limit on how many bereavement leaves they can get per year. You can also ask for proof, you know, if you have that chronic employee that's like, they're constantly trying to take bereavement leave. This is a non-paid leave, but it is something that has been put on the California state books. Also, if you're in the hotel industry and now also in the beauty or barber, nails, spas, hair salons, you're required now to have a posting about human trafficking and slavery. That's been out in the hotel industry for a while, but now they're extending it into the beauty industry because that's where they're finding a lot of violations. So the penalty for not having the sign is $1,000. And we have the codes here for you so that you can look that up if you need that. And that's all, folks. If you need help, you can, and you're an SBDC client, you can make an appointment here with the center to have free HR consulting. And if you're outside of our service area, you can contact me at these contact information, and I'll put that in the share as well. So that's all the updates, Kelly. Kind of short, sweet, and simple.
Yay, fantastic. Great information as always.
Thank you.
And you'll stick around.
Yes.
Talk about my takes on some of this stuff and finish up a little of the introduction I do, but I thought it was best to jump into that right away.
Yes.
So I will go back to my share screen and we'll come back to Celeste. Good time to get any questions in the Q&A box. If you have a question over what we've gone through, or maybe even a question of what we didn't go through, now's a good time to jump into that. So a couple other things to go through. Celeste did talk about the fast food franchise for the $20 minimum wage. So it is true that it only affects franchisees in the state of California with 60 locations or more. It does exempt those that bake their own bread, ironically, bake their own breads on site. So that pertains to Panera, but not Subway. But in my estimation, is it affects all food businesses, and it affects significantly mom and pops. As Celeste mentioned, it will kind of raise the bar for all of those particular businesses that are going to be looking to hire food service employees. And, you know, the example I like to use is that in your particular business, you pay minimum wage for entry-level positions, and maybe you've had a line cook who's worked for you for a couple of years, maybe food prep, whatever, and maybe they're up to $18 an hour. So now you have a minimum wage coming to where they can make $2, maybe even more. Let's say $2.50 an hour full time. That's $100 a week. They're going to be actually asking for a wage increase, or they're going to be looking to move on to maybe a fast food. And, you know, fast food restaurants, historically anyway, have been entry-level positions. They've been positions where oftentimes you get your first job. And it seems like that is going to change the scale, and that's going to now impact a lot of our food businesses and beverage businesses that have worked with more skilled workers. So that is something to keep in mind. And I just think another really threat to mom and pop restaurants and independent eateries that are going to be in that particular area.
Well, and Kelly, if I can add on that too, it's like you'll have people that are the counter people often get paid a little bit less than perhaps the ones that are doing cooking. So there's always a little bit of wage there. So there's going to be some that are going to get pushed to 20, and then they're going to get a little bit more than that as well, you know? So yeah, it's going to raise quite a bit.
And not a lot of tips in franchise type business or fast food, but there is definitely some tips for servers in franchise type businesses. So that it's going to impact. And then you get into that difference that you always see in a food business or a restaurant where tips are involved, is where you have servers who are oftentimes making at least their salary in tips per hour. And you have the back end people that really need to be compensated more to try to factor in that injustice. So what are some of the things that we can do to maybe minimize the impact of wages increasing for all types of fast food businesses, some franchise businesses, but also our independent restaurants? And, you know, when I'm talking with people, it's, you know, obviously, I think restaurant businesses need to think on how they can reduce labor in their particular business and how they can do that. Obviously, technology is going to play a part. I know Celeste might mention that you might want to start looking at your menu and devising ways to move away from more labor-intensive dishes, maybe those that have a lot of prep time to it. In the past, it seems like we've always been looking at food cost on menu design and things like that, on the cost of those high food items. But now it's really the labor that goes into them that is affecting the overall price of that dish as well, and eliminating a lot of those process times. So, you know, I like to call it a 20%er. And, you know, that is, right now, from the gauge that I get in talking to a lot of independent and mom and pop restaurants, it's the 20% are the ones that aren't struggling right now. We see struggles still with about 80% of those smaller businesses, and it's the 20%ers. So what can we do to become more successful, scale? What marketing, what other tips can we do to become what I like to call a 20%er? So mom and pops continue to remain under siege. And we had mentioned a lot of those factors there that kind of move into there. And the other thing that kind of is concerning for food businesses, but also small businesses of all kinds, has been the dramatic increase that we're seeing in bankruptcies and in business failures. So wanted to talk just a little bit about some of the things that you might be experiencing in your business if your business is having a tough go at it. There might be some alternatives out there that you haven't thought about. So as this continues to become more and more an issue with small business bankruptcy attorneys saying that their demand for their services over the past year has doubled, and there could be even higher, higher ways of doing that. There's ways of actually kind of working around that. So we will get into a few of these. We talked a little bit about the IRS putting on hold the ERC claims. And also we have, really something that we've looked about, the employee retention credit. So a lot of those funds that maybe a small business or a restaurant might have been depending on coming in with the tax credit really aren't going to be happening. So it kind of brings us back to our local franchisee here in Bakersfield and some of the issues. And I'll tell you where I have taken exception with this particular case. And I will be the first to tell you that I, at one time, have used the labor commissioner. I think the labor commissioner offers valuable services, particularly for those that are actually impacted by a bad actor. But again, as I mentioned, I think too many small businesses get swallowed up into being labeled a bad actor. And again, I don't know the exact situation of this, but to kind of come down here to where we get the quote from the labor commissioner saying that this case highlights abuses that take place in low-wage industries. I can agree with that. It can, such as franchise fast food restaurants, where separate corporations are created by the same employer to improperly lower labor cost. I have a problem with that. Having talked to two particular businesses, food businesses, last week before this came out, and we discussed this very same topic about maybe if you are adding an additional location, you might want to minimize your risk. As Celeste said, why take down the whole business with one bad particular venture? That is really where people talk about the need for this. There are costs involved in adding additional entities, having a different LLC or a S corporation or corporation. So there's costs that are involved in that. And those costs include an annual fee from the state of California, probably $800. There's additional accounting and bookkeeping fees in order to try to keep everything separate. So there is a cost to try to minimize the catastrophic damage by having all of your food businesses under one shell. And that really kind of was highlighted in the pandemic when we did see some failures that happened from those particular businesses. So having this discussion twice last week, and not once did it come up that you need to actually create a different entity for your different, let's say, restaurants in this particular case to lower labor cost. And of course, maybe one of those reasons now is that the labor rate is the same. So whereas there was a slight difference between as small businesses were given an opportunity to scale up to a larger minimum wage, we saw that. I just don't see that. I don't see that is done in order to actually lower labor cost. And even now, it doesn't lower labor cost with the rate being the same for both under 25 employers and over. So that was my first problem with this particular case. So the other one is that when you look at it, these minimum wage violations occurred in 2019 to 2022. And by identifying, as Celeste mentioned, she did the math like I did, 551 employees. So if you're trying to maintain 5 restaurants where to keep that lower minimum wage cost, you could only have 24 employees. So if you did go out to do that, which I don't believe was the case, you had a maximum of 120 employees at a time. 551 kind of brought everybody in and kind of enhanced the penalty phase as far as the waiting time penalties for people waiting for the final amount of their check. It also had $238,000 in liquidated damages, but really, come on, $1.2 million in civil penalties payable to the state? Is that what this is about? Yeah, I didn't think so either. So that is kind of the case, the problem that I had in this particular case, where the numbers really, if there are, and apparently there was some damages, they don't appear to be done by a bad actor who is basically singled out for trying to improperly lower labor cost. Okay. So there is my particular issue with that. So when we do break down those particular costs, what does a $3 million bill labor, what does a $3.1 million bill from the labor commissioner look like? Well, Nick Bosa doesn't know, and he makes $170 million a year. He might not know what $170 million looks like being paid with the highest salary ever by a defensive player in the National Football League. If you're a small business owner, it probably feels like that you have been dumped totally on your head if you have a business that's not going to be able to withstand $3.1 million fine if paid altogether. But really, it's about really going after the bad actors. And in my situation or my experience, I didn't see this one being a bad actor. So you do see that the wait time, and the wait time is basically a 30-day penalty, the wait time penalty it's called. And that is if somebody isn't given their total wages, and that could be from maybe missing a lot of different reasons, but that is going to be 30 days of each of those employee wages. So if you're looking at 551 individuals, it's going to be additional 30 days of full-time wage for those people. When you get into the minimum wage violation, I don't want to try to make excuses. Minimum wage is going to be a violation, but in this case, it's the difference between that 50-cent premium of actually being a larger employer over 25 and under. That's all it was, $87,000. And then off of that comes from the minimum wage violation comes the meal premium. There could be some overtime. Overtime needs to be paid, obviously, contract wages. And then you come down to the big three. $77,000 for interest, liquidated damages of $238,000, $1.2 million for a civil penalty. In addition to the wait time, which goes back to all employees, 30 days of their particular wages. It doesn't seem like this particular case, with such a small amount of the minimum wage violation between that, is a potential bad actor. I won't get into the terms as we are moving along on this particular one. And we did talk about some strategies, or want to talk about some strategies for struggling small businesses. And that includes all types of businesses. Ideally, there's a vehicle for where you can turn around an unprofitable venture. And there are turnaround solutions that are really becoming more prevalent. One of the more common is to exit the particular business. Sometimes it's forced. It's forced by you run out of money and you run out of cash. And you don't get the opportunity to sell. And maybe your business goes into a liquidation. But if you can liquidate that particular business, it's going to be far more beneficial to you than sell and reap the goodwill that has grown in that particular business. Oftentimes we'll look at rules of thumb and we'll look at valuations that are occurring and look at small businesses that don't often reflect a valuation or a high enough valuation to sell. And right now, 80% of the businesses that are listed for sale do not sell. And that's for a variety of different factors. One of the factors is that oftentimes the smaller businesses really can't get a lot of good representation because they don't generally produce enough revenue for those people that sell particular businesses. That is one indication. And those are going to be your small businesses that really need a lot of assistance in this area. So with these valuations really not reflecting a lot of the goodwill, when you look at a restaurant, the startup costs are incredibly high. To do leasehold improvements that have already been done, the hood, the grease trap that are in place, maybe the location, maybe the restaurateur had a bad concept. Maybe he got hit with a $3.1 million fine. I will comment on the Subway example, though. Subway example, that seemed a lot more like a bad actor to me. And it seemed like a lot of the things with coercion and some of the other items that I read on that particular story seemed like a potential bad actor in that particular case, of which I don't have much mercy for. In this one, though, with the startup costs being high in a restaurant, there's valuation in selling it to the next potential restaurateur rather than turning it back as to potentially the landlord with improvements that you have already made in that particular business. So look at these potential ways of strategies for exiting a struggling business. So we looked at leasehold improvements, and another thing really to look at is the assumable debt. We're starting to see now here at the SBDC where individuals that had a COVID idle, that under the terms of that COVID idle, don't know the loan amount, they vary, but the interest rate at 3.75% over 30 years is a very, very favorable loan to be assumed by a potential buyer. So having that COVID idle, make that payment. Don't let it go into foreclosure, as that will be a huge problem. Get in front of the situation and let's try to sell the particular business, have the buyer assume the COVID idle or other debt that you might have, and avoid a even more catastrophic situation down the road. One of the things coming down the road is SB 1407, which was passed to assist employees purchase existing businesses. So we've all heard of ESOPs, the employee stock ownership purchase, of which is generally businesses that have employees of over 100 and they band together. This can be that situation on a much smaller basis. It can be that waitress that's working in a particular restaurant that's been around for 30 years. Maybe the owners do want to retire. And so by finding monies and ease of ways to get them in and the existing seller out are always going to be more desirable. So when you run into situations like this, please contact your SBDC, and there's ways that we might be able to help as well in putting these particular individuals together and funding that might help. Well, you've heard us promote the Employer Research Hotline, and I don't see a better need or reason to, after today's program and what we've discussed today, to make that available. But there is free human resource hotline available in various counties throughout Kern, and Mono, but also throughout the San Joaquin Valley, the Central Coast, and other areas along the Sierra foothills. So each area does have their own separate number. As you see right there, there are plenty of phone numbers available given your geographic location. On our community calendar, as we move along, Small Business Expo is coming up, the State of the Black Business, and that is coming up, and that will be sponsored by the Kern County Black Chamber of Commerce. It's going to be October the 26th, and we will be there. We will be there in force at that particular event. Our small business credit survey, really trying to find out what the needs are for our particular region. If you're looking for access to capital, if you've received access to capital, if you cannot get access to capital, you're all three really strong clients in order to go to this small business credit survey. That takes about 10 minutes and provides a wealth of information. One of the bonuses we're going to get this year by having a large enough sample size for our particular region is we're going to get data that is going to be inclusive to our region. So it's going to be inclusive to Kern County, or maybe the San Joaquin Valley, or maybe, the CSU SBDC range of Kern, Inyo, and Mono counties. So we'd love your feedback today. Go to our Google, review us on Google, give us that positive feedback. If you have any other issues, give me a call, give me an email. My email is out there. You can call our office also. Look for your survey after the email. That's a good place to do that in email form after the webinar. And also you can go to our CSU SBDC YouTube channel, subscribe, find all of these particular webinars, for example. Daycare, we've talked about the great need for daycare providers and a great opportunity also for entrepreneurs to go through training to profitably set up your daycare business and to run it and provide really good benefits for yourself and the particular community. Up to about 369 subscribers to our YouTube channel. Go there. These webinars go there every week that we have it. And that is going to take us to the end of this webinar for today. I'm going to go back right now and go into the chat box and look and see what we have in chat. We have a lot of the resources that we just kind of went through as far as a lot of the events and a lot of the things. So a lot of the resources here, I do not see any questions in here for Celeste or I. And okay, so that'll wrap us up. So Celeste, any last comments that you might have or anything that you want to say before we get out of here at 1 o'clock?
No, I don't think so. I just think it's important that they either hook up with a SBDC or a Chamber of Commerce so that they can always be aware of all the different changes in labor laws that happen each year. So that's it. I think knowledge is the best thing to help prevent issues in the future.
Sounds great. Okay, well, that's going to wrap up number 293. Yeah, a lot of labor stuff to go through. Boy, it's a tough field to navigate because you do have a few other things you have to do in your business rather than be an HR specialist or a human resource lawyer. But anyway, that's it for today, number 293. Appreciate you attending today. The great support from Celeste Young-Ramos, who as an SBDC consultant could be available for you and your business. So keep that in mind as we move along. So for Celeste Young-Ramos, I'm Kelly Bearden. We'll see you next week. Goodbye, everybody.